Hey guys, Freaky Finance here. You can see behind me we're getting ready for Christmas. Like Griswold family special this December anyway. So I think for December I want to try to focus on toys. I know last year was Jack's, that was an easier one. Today we're gonna do Funko. There's a couple other ones that could be interesting at some point. There's Build-A-Bear, which is also almost getting cheap. Some people would consider it cheap. It's not dirt cheap. Funko is more of a growth play than a value play, and right now it's not growing, and that's why it's very weak. So this one, Funko, I'd say, is a riskier position than other videos we've done, especially lately. And this is just one that's starting to get relatively cheaper, and I kind of want to get the video ahead of time as I expect more weakness to persist at some point. But we'll see what happens. So anyway, this is Funko. Funko really has three businesses, but the main business is basically these pop vinyl figures. And basically they're a collectible thing. You'll see them what exactly the product is. They're not familiar when we go through the store and the three online stores they have and what each of them are. They are headquartered in Washington. We'll see that when we go through the properties that they own, or lease rather. And there's a couple other things here. There's some good things, some hair, and some recent weakness, and that's why we're getting relatively decent price. But again, this is what I view as a riskier play. Anyway, so here I do own this one. I've just started position. It's finally getting somewhere where I could maybe poke a shot at. It's not yet back at the August lows, even though performance was still very bad. They slightly beat their really bad guidance that they gave in August over the summertime. So that's probably why it's not taking a higher low yet, even though the performance itself is, I'd say, fairly weak for November, for the September quarter. And yeah, I think as comparison purposes to other videos, I'd say Jack's is probably the closest one, though they're totally different. Jack's is an easier one because the people kept selling it down to me at 15 when the performance was actually getting better. So this could still happen, and sometimes that happens to companies where the performance is actually getting better, materially better, and the share price is just lingering or bouncing. It's going up, and then it comes a big sell-off down with the market at some point, and you get another shot at it. And I'm hoping stuff like that happens more as we get into the early part of next year, but I'll do my end of the year thoughts near the end of the year. So anyway, Funko, like I said, has three main brands. The 75% of earnings and sales, probably even more than earnings, are the pop vinyl. They have a lounge fly that they picked up a while ago. They have lots of pictures of backpacks on their website shop. And then they have Mundo, which I say is I'd say it's more higher end. You have like limited edition stuff. And so instead of like a $15 or $25 pop vinyl figure, you have something that's a $250 figurine that's a limited edition kind of thing. And I think this is where the market's eventually going to keep going quite a bit. And I think they need to take price more on the pop vinyl side, the collector side, because I don't think these are that price sensitive if you're going to really like the thing. Anyway, in terms of their brand, so this is why it's kind of like Jack's, that they license IP from other places. So Disney, Harry Potter, that's your Warner Bros. Again, more Disney with Marvel and Star Wars. Universal, you can see quite a bit on here, quite a bit of IP that they have licensing agreements with. So what that means is when they sell something, they basically kick royalties back to the IP provider based on whatever agreement they have with them, and that shows up in COGS. And we'll go through that as well when we go through financials. So in terms of history, they got the licenses back here, so it's been around for a decent amount of time, but they didn't IPO until 2017, so I only have information to go back till then, so that's what I did. We'll go through the annuals to see the trend over time. They did get caught up in the NFT thing in 2021, and then they decided to buy Mundo in 2022, probably at a higher multiple than what they should have, but I don't know that. And now they're starting to try to branch out into other things. They have a Bitty Pop thing, which is like a smaller version. Anyway, the main thing here is that they bought one of the other divisions in 2017, so you're going to see that in Goodwill. And again, they bought Mundo, the other division, in 2022. But again, the bulk of the business is the pop vinyl player, which is the organic grower. That isn't to say they haven't built on this brand over time. In terms of properties, all leased. They're currently negotiating leases to try to get the cost down. Very heavy into the Washington area. That's where their headquarters is. And there's a decent amount of capex with this company, tooling and stuff like that. So you're going to see a decent amount of depreciation, though they are one of the reasons why the profitability was improving going into COVID and during the 2021 year is because they do have quite a bit of leverage on the fixed cost side. So when sales pick up, you do see that go to the bottom line. But conversely, right now you have sales going down, and it's also going to the bottom line. So it's That's basically a normal scale thing. And there's a decent amount of capex, probably more than people expect for a toy. Or not a toy, but a collector's thing. And using molds and stuff like that. It's kind of why I treat them like toys. It's kind of how they're linked in my head anyway. So here's the store for the main stuff. I'd call the pop vinyl side, Funko shop. And you can see they have everything selected, different categories, and new releases, exclusives. Right now they're trying to peddle Michael Jackson Diamond. So quite a bit of stuff there. Again, here's them. But that's kind of what the product is. You can see the price point, $12, $15. And then the backpacks, which would be on the Loungefly side, $120. You kind of get the gist of it. And there's the backpack on the Loungefly side, the higher price items. And then on the Mundo side, they do actually have vinyl of the mugs here, but you can see some Skeletor, He-Man, Master of the Universe stuff, She-Ra. So again, while these are sold out, they're supposed to be that kind of scarcity thing. A lot of them are sold out, rather. So they only make limited amount of editions, hence the premium price, and then over time maybe these things actually go up in value because they're scarce. And some people just really love collecting these type of things, limited editions. So anyway, it's kind of a different business model than the pop vinyl figures, which are priced like you saw, between at $15 and $30. I see some of these could also go up in price if they're limited or scarce enough. Maybe before we jump into what they're doing and kind of what I don't like and like, maybe we'll go into the actual annual financials. So yeah, let's just jump to the numbers. So here's the annuals. Let me just make this a little bit bigger. So here's what it say for the business. You can see from the IPO, they actually were doing fairly good in terms of revenue growth, going from basically 500 million sales to 800 million sales. Pretty quick growth. Then you see the COVID shutdown year, and then you see the too good to be true year. We've seen this in other retailers that we've done on this channel. And again, you see further growth in 2022. Now, what's happening in 2023 year to date is that we've actually seen sales decline. So you've seen the share price come in materially because it's no longer a growth story, it's a shrinking story. And importantly, they chased the performance in 2021. We've seen this with other retailers that were had less history into a recessionary environment. And goods are in a recessionary environment. So because of that shifting that we saw last year from goods services, it's still going on right now. But anyway, this was another casualty of that short story. And what they did is that they overhired, and then they also put a lot of capex to work. And they also over inventoried. And so now they're still dealing with that. And I'd say they're slow to deal with that. And now they're finally dealing with it, or at least they have a strategy that I actually like. That's why I started the position. I'm hoping to get in a cheaper valuation. That isn't to say it's not cheap if they can do what they used to be able to do, but it's not dumb cheap like some other things. Like Jax was trading at 2 times EV to EBITDA, right? Now it's at 4, right? Or 3.5 or whatever. There's other companies that are dirt cheap. This one's getting there. It's just not quite there yet, and it is still execution risk because current earnings are still very bad. So, but they're doing things that I would be doing if I was in that position right now. Let's get into it. So you can see there was a decent amount of leverage going to operating income here. And in terms of EBITDA, on an adjusted basis, it was still going up with revenue. So there was scale here. So what you'd expect. Ultimately, even in 2019, we did see a relative lack of cost discipline. And that shows up like a sore thumb in 2022. In 2021, the sales growth was so high, like you just went basically like from 650 million to $1 billion in sales, that this year was just obviously too good to be true. And what they did is they decided that this was going to be, I don't know, they basically were operating on the assumption that this would continue, or at least they didn't manage inventory as if it was going. They over-earned. They just, I don't know if it was arrogance or what, but they just thought, yeah, no, our business is this much better now, permanently. And now we're dealing with the mean version of that mistake or relative lack of judgment. You can see depreciation is steadily going up. Again, a part of this is the capex. They have been going more and expanding more, trying to go to more SKUs to get more different pulp vinyl figures, right, to get as much as they can at a certain hype cycle. And we'll talk about the current change of strategy where they're kind of going back to the more evergreen side. And the evergreen side would be their legacy IP, so the ones that they already have long-standing agreements with. Whereas a new thing might be like get that hype on that new movie that's coming out or something, where they try to make a whole bunch of stuff around that movie, which sounds good in theory as long as it sells, but when it doesn't sell, then you just incurred a whole lot of costs. I have all these molds that you made for this product that's not selling, right? And then it takes up your other lines that might have just sold just fine over time. Basically, we've seen this story before. You have a weak year from the shutdown, the share price tanks, and then you have a too good to be true year, the share price goes too high, and then you have reality coming in 2022 and 2023. 2022 actually wasn't bad in a sales year, it was just really bad in terms of a cost management year. Partially because inventory turns just tanked. And then, yeah, so here you can see interest expense is actually going down. The company was actually on a deleveraging path going into COVID, and then COVID totally screwed up. I'd say it screwed up the trajectory of the company. They got a false positive, which made them chase and made some management decisions, in my view, that were not good. And then now we're dealing with the result of that. Here you can see, we'll talk about minority interest. So here, we haven't actually talked about it yet, which is surprising. Comes up more often than you think. Here you have net income, and then you have net income to common shareholders, which would be me. Minority interest is the other guys. So people that have a large controlling or non-controlling stake in the company. What's been happening, and I have a tab for this, we'll go to in a sec. But basically, the minority interest is slowly coming down. Basically, from the IPO was an exit strategy for these guys. And over time, Funko, with the proceeds from the net income, have been buying back shares of this other company, which is increasing the ownership of that for Funko. But at the same time, it's basically it gave more of the earnings up front to someone who wasn't the common shareholders, aka someone who wasn't me now. That's what's been happening. Now it's getting closer. You can see that in this metric down here, total. So not net income total divided by net income common shareholder. The closer that gets, the lower that gets, the better it is. Anyway, that should continue and continue to approach 1 when there's earnings that's positive, obviously. That's slowly been happening. So what happened is the earnings are front loaded to go to the other non-common shareholders. And that's slowly being, I'd say, mitigated over time. And it's getting closer. We'll go into the percentage terms, but I think it's already about 90% now. Instead of back then, it was only like a third that were going to common shareholders. We'll talk about that in a second. You can see the share price. We already talked about reacting. Company's a zero diluter. It's the main source of financing for its growth. But it does have debt because it's made acquisitions as well. You can see that here. So you can see total indebtedness right here. It was going down slowly with the free cash flow, and then it reversed in the last year due to weak inventory management and high capex spend. What do I mean by weak inventory management? You can see the turns going from, say, 4 and 5 to 8, so very good. And then all of a sudden it goes from 8 and 6 to 4 and 3.6. So obviously very weak inventory management here. Or maybe too good to be true here. But you can see it's worse than it was in 2018. So they're obviously doing something wrong in terms of inventory management, or they have been. Now, one of their things is to fix that. We'll go into what they're doing to fix it. It's just worth bringing up the inventory turns. And an easy way to visualize it is you can see here they had about 62 million in inventory. In 2021, they had 166 million inventory at the year end. So that's almost a 200% increase, right? And their sales only went up 30%. So when you have 30% more sales, maybe you could have 30% more inventory. If you're doing something right, maybe you could actually less than 30% more inventory. But you had 200% more inventory. So the fact that management didn't try to rectify the inventory situation here is a mistake. And that's a mistake that they're still paying for even at the latest quarter. And it showed up like a sore thumb in 2022, and it's so far it's showing up for most of 2023, I'd say all of it. Basically here they're probably just building SKUs for everything. That's what I'd say. That's what it looks like to me. And things weren't selling in 2022 as much. In terms of EBITDA, it's actually a decent company in terms of EBITDA generation historically. Now, currently it's very weak. Even worse than this, than this drop-off. If it can get back to what it used to do at the current valuation, you have to remember currently it's only at 281 million in equity EV, which is very cheap for a company that's doing 1.3 billion in sales now. I mean, it's cheaper than it has been when it was doing 500 million in sales. So you can see that relative to its sales growth, it's probably cheap relative to its current numbers it's putting up financially. In terms of performance, profitability, very weak. I think that's the main thing. I think that inventory comment's the main thing to pull from this page. Like when you have inventory going up almost 200%, but you have sales only going up 30, yeah, something's going on. And they took a full, like, this is 2021, they took a full year. They haven't actually had a strategy until the middle of 2023 to deal with it. So they basically did nothing in 2022. These are just comments to myself. If you want, you can freeze frame it. But the minority interest is interesting. We should, before I jump into that, we should talk about TGC. We'll talk about them in a bit as well. Or TCG rather. Basically, they now own more than 25, I think it's around 25% of the company. They actually bought a percentage from another group called Acon, which is the people that, basically a private equity firm that made these guys go public. And basically, Acon's been getting out ever since, and they got out the rest of the position in 2022 at the high. So basically, they showed 2021 numbers, because that would have been out around March 2021, or 2022 rather. And then they sold it all to these guys in May 2022. Basically, these TCG guys are holding the bag. They bought it over $22, I think, a share. So relatively crazy premium to what we're currently buying at $6 a share. But again, that's what private equity people do. They really just very short term screw each other over, constantly buying and reselling things, make them better, resell it again. Right? They're never long-term focused. Anyway, so that is a concern of mine. Like, I'll never be comfortable putting too much in this, because there's a possibility that I get screwed over by one of these guys or one of these teams that are just, as a collective entity, would be smarter than me alone. Anyway, here you can see non-controlling interest of assumed exchange for common units of FAH LLC. So basically what this means is the proceeds that the company was generating here in the earlier years, they're basically going to an exchange for common units of FAH LLC. So what that means is here you can see that Funko slowly increased their position in FAH LLC, and it went from a 69.5% ownership interest to a 91.6%. Again, this was another way to get the IPO, private equity guys, and whoever else was trying to exit strategy, a way to exit over time with the profits of the company itself. And so that's largely played out. So there's no longer going to be this huge gap where net income's $25 million, but us, the common shareholder, would only get $7 million. That gap is narrowing. It's still not perfect, but it is narrowing. So it's worth bringing up because I thought it was interesting, and it is unique to these guys. It is a private equity bounce. That's what I call it. It's going to keep bouncing. I've seen this before. And anyway. We don't need to go into too much detail here. The debt isn't great either, and based on the current economics and the current numbers are pretty enough, it's still pretty bad. The creditor, I think, honestly, I have to believe here, because they didn't have a plan until the middle of 2023. It feels like the creditors decided, like, you guys need to do something, because they weren't managing it themselves. So here's the creditors basically being more restrictive during 2023. Basically, what was happening, they had a revolver, and they're basically at 185 million or so, or 180 million, and they said, you know what, you can go up to 215. And then a couple of years later, they're like, you know what, no, you got to go down to 180. And by the end of December 31st, you have to go down to 150. So they're basically bringing in the revolver. I mean, it's the creditors seeing them as a credit risk, right? They have a whole bunch of restrictions here. The covenant ratios are net leverage ratio and your fixed charge ratio. If you were to do that on the current numbers, the current EBITDA is very weak. So not great, and the current EBIT is also very weak. So, so if they were in compliance at the end of 2022, it's likely they aren't at this point, which means you need them waived or you need some negotiation. There's also a risk of permanent loss here, right? Though most creditors are in the business of working with their lenders, but sometimes they can also take steps. And there is also, these guys do have two directors now, TGC or TCG, and that will also be in play here because they do still own 20% of the company. Again, these guys are the guys that got burnt by the other company, right? Bought a 25% stake in the company at $22 a share. Now it's at $6, just in a year, or 2 years in May. Anyway, it's not a good look. The current quarter is obviously very bad. Like, if I were to try to reverse engineer what kind of EBITDA they need to generate in order to warrant 267 million in net debt, which is what they're in right now. You would need 107 in order to be compliant with the covenant, and right now they have 3.7 million. Right now, this is a weaker than it ever should be number. Like, this should be better based on what their plan is. And to be fair, the last quarter was 25 million. So if I run rate that, that's 100 million. So you could make a case for being close to this. But right now, based on current information, it's likely not. So there is a risk here that this gets pulled by the covenants. I'll say that will happen. It's a possibility, and we should be aware of it. It is a very high risk, or it's a higher risk thing. Like, obviously, a creditor, like, you're seeing growth go from 500 million to 1.3 billion. So they have something special. So you're probably going to give them rope. I don't imagine them pulling it, but they are protecting themselves. And I think that's forcing these guys to do something. And yeah, the current results are very weak. Like, here you have sales down 20%, so it's no longer a growth story. And then you still have SGA up, so you still have a lack of cost control, right? At least on the 9 months to date. That, to be fair, they just started taking action in August, but they're in Q2, Q3 anyway. So we'll see. They are starting to add some stuff back, so they are starting to see severance show up more, and also start terminating leases. So anyway, they're starting to pull some cost out, but it's still very early and anything could happen. All right, so let's jump into it. Again, you had a pretty strong initial, I'd say, results period in 2017, 2018. You had a decent revenue growth, but a lackluster, I'd say, a profitability profile in 2019. And then obviously you had the COVID panic, which did hurt the company. And then you had a too good to be true year in 2021, right? And then you had the guys exit in 2022 in May, which basically is almost near the high again. And so that's when the TCG guys now own 20% of the company, more than that. And now you have the reality of the overhang of very weak 2022 year in terms of profitability, but still okay sales growth. And now in 2023, you have very weak profitability and no sales growth. In fact, you have sales decline. So you have everything bad right now. And so that's when you either find the best deals or they go away forever. And this one's one where it could go away forever. So I just want to be very clear on this video. It is I call it one of the riskier ones that we've done. And usually the only reason why I'm doing the video now is because I have a plan to address the weakness, but we don't actually know if they'll execute on that plan. So anyway, you can see the profitability. They're aware of the situation. They've seen the profitability profile despite almost 2xing their revenue. Their profitability profile has gone from 17% margin to 7% in terms of adjusted EBITDA. So very weak in terms of management of cost. So the first thing here, they have 4 plan of action ideas. So the first one is stabilize operations. They claim they've eliminated the extremely expensive short-term storage costs. Again, they had an inventory problem they were not managing. They were just keep buying and building inventory, and they were not managing it at all, so they're incurring extra warehouse costs. They claim they renegotiated freight and logistics contracts. That's good because they keep going lower as well. The spot rate's even better than it was, and contract rates continue to decline. And they have finally, this is true, they have lowered inventory levels. So we're starting to see cash flow no longer be as bad as the net income is. We also see them remove 22% of the workforce now since April. So it's 8 months now. So decent amount. They say combined that those two workforce reductions should be about 30 million. Again, the company's worth less than 300 million now in equity EV. So it is trading relatively cheap to what they're currently starting to pull out of the business in cost. Here's the second one. So that's focus on core product. Here is reducing SKUs by 30%, which is good. Basically, like I said, it showed up that the inventory turns were just out of control. This is a way to get them back into control. It's actually just making less of everything and just more of the things that are likely to sell. Because you can't appease everyone or else you go bankrupt. So you need to do this. I think it's only rational, especially after the lack of execution that we saw on the financials. And I agree with all these things, and I do think the evergreen focus will be better than just going for the latest trend, because the latest trend you don't actually know. It's harder to tell how successful that product will be that you're making, how much it will actually sell ahead of time. Whereas evergreen, you know, eventually it's probably going to sell at some point something, right? To be fair, they were perhaps overly exposed to Disney products, which have also been seeing some pushback lately with the woke and all that stuff that you keep seeing. So there could be some of that also influencing their product sales. They have started doing this. I think I talked about how they're going the Biddy Pop. Again, you're going down to a lower price target, $3 to $15, and then you have to pop yourself. So they're doing some stuff here. I do think the new verticals like anime is popular, gaming is popular, music and sports are always popular. Obviously, sports will be a harder one, whereas I think gaming and anime are just easy growers. People that want to buy this thing are going to buy them. Whereas sports and music, you might have to actually get someone who likes these existing things that they're likely to buy, like gaming and anime, to actually buy the sports and music for their significant other. That's just what I'm thinking out loud. So we'll have to see how that works. And then long-term growth profile. So they do have a lot of places to go internationally still. They do have their online stores that are actually still growing. It's just the retailers that are pulling back on them. We'll have to see what happens and how the margin profile should improve the more DTC they have. They are more in control of the price. And they can adjust them up and down quicker. They can also see the end customer data better if they go DTC. So I like DTC more anyway. So we should see that. And the shops didn't actually look bad, right? They look pretty clean for buying stuff from their own website, right? This is my opinion. All right, and then here they claim that they've pulled about 150 million from the peak Q4 2022 levels, and most of these are pretty recent, Q2, Q3s. So they started to take price increases, factory cost negotiation, eliminated container and short-term storage costs. Right, they've disposed of inventory, they've done headcount reductions, right? So they're doing things that I would be doing, and they're also delaying new initiatives good, and they're also expanding evergreen, right? Which is the old school IP that they have that's more tested and true. You're more sure of what the results are going to be. So anyway, I like all these things. They're all things that I would do at this point. And here is just a gross margin bridge. You can basically, it's what you'd expect. They're taking price. But again, they have too much inventory still, so they're mixing discounting, so they have discount to move over inventory that they have. We are seeing freight shipping. We've seen this across a lot of different companies by now actually improve year over year. That trend should keep continuing. So at some point, we're probably near the low in terms of gross profit margin percent, but it's hard to tell for sure, but it should be nearing the low based on the things that they're doing. But again, we haven't actually seen that in the numbers yet. We just started to see them pull out cost. In terms of the governance and board, so we did see, this is the transaction where Acon sold their stake and most of their stake anyway, 80% of Acon's investment stake at $21 a share, and they'll now TCG will own 25% of the company. We know that they now get 2 directors, which they finally got at the beginning of November 2023. But anyway, you can see here, according to this article anyway, they claim that additional investors of the consortium include eBay, Bob Iger from Disney, now the CEO again, Rich Paul, also on the board of directors, I think, that I've read. Jesse Jacobs is one of the directors that's actually already on there. We have a new one as well. It's Kearns. They did buy Mundo right after they did this deal for probably too much money. So this could be one where they just burn the common shareholders and take it public or take it private at a cheap price and then resell it years later. I've seen this a few times, so that's why I'm not super excited about this one, but I want to do the video because there is a lot of work here, and it is a funner one. Like what we've seen in other private companies is that basically they come in, they make a bunch of acquisitions, they take the price down, they just buy it out at a premium. And now it's a private company, and then a couple of years later they fix it and they put it on the market and reap the benefits. We've seen that over and over again in private equity. Basically, they just screw over the common shareholders and make themselves wealthy. So that's why I kind of have a weird stance on this one. But it is a fun company, and it has the potential, like the long-term revenue growth is there, right? Anyway, this is Mike Kearns, our second director. He got on November 2nd. He's there. He did see eBay and Bob Iger and that consortium, right? Now you can see the end result here. You can see a $2,000 pop vinyl signed by Bob Iger on eBay. So I just thought that was funny. Here you have the ownership interest again, TCG 25%. You have these guys would have been constantly been adding. I'm not sure what their affiliation is. And you have a couple other guys. This is the CEO who just decided to step away. He's currently selling stock. And then you have the old exit guys here still have a token position. So anyway, there's a lot of guys that have a decent amount at stake in this company. So that's why it's hard for me to know if they're going to burn common shareholders or not. But anyway, there's quite a few funds here that have a decent position size and exposure to this company, which would normally be a very good thing. But it's just harder for me to judge that based on the current structure of the company and the fact the CEO is currently taking a rain check. What else? Short interest is going up, probably because the performance has been so bad. Markets are probably going to keep increasing the short float because the performance isn't there right now, so you're kind of speculating that it gets better. There's the guy the group's named after. The two guys on the directors are Jesse Jacobs and Mike Kearns now. A lot of sports dudes, so we're likely to see more sports focused on the pop vinyl side, which could be a good thing. Again, in my point of view, you need to bring in, you almost need the people who are going to buy the gaming collecting stuff and the anime collecting stuff. You'd almost convince them to buy the gaming or the sports for their significant others kind of thing. That's what I'm thinking. Who's Peter? So anyway, he produced Rise of the Planet of the Apes, probably the biggest film. He's a film guy. I just thought that was worth sharing. Here's a working capital. Advisors buying a whole bunch pretty much since August, since the very bad results they've been buying. We'll have to see if that continues because November was also pretty bad results and the share price is finally getting cheaper again. You can see the CFO stepped in at $5 in August, near the low. So they are relatively active on the buy side, which is a good sign for me if I'm worried about governance, which I am. But here you have Brian. Funko's been my layer of love for 2 decades. I plan to stay active on a board. And then you have him sell shares at the end of November, or at least put in a Form 144. And then I just wanted to see the old company, see when they acquired them. So again, these guys, Aecon acquired Funko in 2015, repackaged it, made it pretty, took it public in 2017, had some good results, had terrific results in 2021, and dumped it on TCG. So, right, in early 2022, right after the strong results were posted and audited. So, this is all the things as basically a private equity punt, where they just keep punting to each other and basically make the business better, or tank the business, buy it out at a premium. So that's private. And then you make the business better, then you repackage it and sell it, IPO it. Right, we've seen this a few times with other companies. We'll have to see what happens with this one. They do have a good plan. I do think all 4 of these stabilized observations focus on the core product. Those 2 are critical. I think that will solve a lot of their problems if they can do what they've lined up to do. And you have to remember 150 million annualized savings isn't small for this company. When I told you the equity EV is 300 million. It kind of reminds me of Big Lots, but Big Lots was a big structural behemoth that had an issue with growth, right? Whereas this one has historically actually been a very strong grower. So there is an avenue here where they can outscale their fixed costs if they can keep growing while doing these things. Right now they're not growing, and that's probably why we're getting a very cheap multiple on historical averages. But I mean, it is what it is. It's cheap because the performance is bad. If it wasn't this bad, then we probably wouldn't be getting this price. So anyway, we've rambled enough. It's a fun one. Next week I'll probably do Build a Bear, but we'll see. I'm just trying to keep more toys focused for Christmas time. There's a lot of ones out there that are getting fairly cheap. This one is starting to screen cheaper, but again, probably mentioned enough for this call. It is a riskier proposition with potential pointy elbows on the private equity side. All right, I'd like to know your thoughts on Funko, and have a great rest of your week.